Today we are going to discuss our next topic, standard costing system. Standard costing system is very important from the exam point of view. You can expect a question from standard costing in the section B of F2 exams for 10 marks. And we know that 10 marks means there will be 5 MCQs and each MCQ will be for 2 marks. But it will be like a short case study, or it will be a question where we will have a data, and this data will deal with the 5 different MCQs. So today we are going to attempt these MCQs, theoretical plus numerical. There are lots of formulas in the standard costing and variance analysis, and we need to remember those formulas for the exams because formulas related to standard costing and variance analysis are not provided in the formula sheet. So we will start with standard costing. Under the standard costing, basically there are 4 different types of standards. These 4 different types are mentioned in this MCQs. First one is ideal standard. Ideal standards thinks that there are perfect working conditions or perfect working environment. It is quite easy for a company to manage internal and external circumstances both for the profitability of the organization. Ideal standards are basically unachievable. That's why it causes demotivation among employees. The other one is current standards. Current standards are basically relevant with the production and sales units. It determines what would be the selling price per unit. It calculates variable cost per unit, and it also incorporates fixed costs. So these are the current standards. Current standards are set for 12 months. Or if we are making budget for less than 12 months, suppose a company is making budget for 6 months, then we are going to set our current standards for 6 months time. If a company is making budget for each quarter, it means we are going to set current standards for 3 months. Then we have basic standards. Basic standards are the one which deals with long term. Basic standards are basically dealing with material usage per unit, and it is also dealing with labor hours per unit. Material usage and labor hours per unit are the one which focuses on input of the material. Basic standard will remain same until or unless we are not going to change the technology of our production process. Third one is attainable standards. Attainable standards are based on available circumstances. It assumes that it is not possible for the company to control external circumstances, and at times it is not easy for the management to control all the internal circumstances as well. Attainable standards are challenging but not ideal. That's why attainable standards cause motivation among the workers, and ideal standard cause demotivation among the workers. So these are the basic 4 standards which we need to remember along with their definitions. Now we are starting with this MCQ. When considering setting standards for costing, which of the following would not be appropriate? Not be. The normal level of activity should be used for absorbing overheads. It is correct. Whenever we are calculating fixed production overheads means OAR multiplied with normal activity level. So OAR into normal activity level, budgeted activity level is one and the same thing. A is correct. Average prices for the material should be used encompassing any discount that are regularly available. If we know that what would be the material price or there will be no significant change in the material price, we can use average price per kg, average price per meter, average price per yard. The labor rate used will be the rate at which labor is paid. When we are setting standards, we will not use the rate which is paid. Paid means actual rate. Our standard rate will be some different than the actual rate. So C is not the appropriate. Average material usage should be established based on, definitely we will see that what are our generally accepted working practices of the organization, what material they are using normally. On the basis of that we can say what is our average material usage per unit. Any question related to this MCQ? Okay, what are the performance standards that have remained unchanged? Remain unchanged over a long period of time. Over a long period of time, basic standards will remain unchanged over a long period of time. What are performance standards that allow for efficient but not perfect operating conditions? Attainable standards are the one which talk about the efficiency, challenging but not ideal standards. Which of the following statements are true and which are false? A variance is the difference between budgeted and actual results. This definition is a false definition. Variance is not a difference between a budgeted and actual result. Variance is the difference between estimated and actual result. You can use another word. Variance is the difference between expected and actual cost or actual results. We can say variance is the difference between flex budget and actual cost, and we can say that variance is the difference between total standard and actual cost. So this is the definition of a variance. A favorable variance means actual costs are less than budgeted. Yes, it is a favorable variance, but again, it is better to use actual cost than budgeted rather than we should say actual cost than estimated. An adverse variance means actual income is less than budgeted. It is also true if we are earning less amount in comparison with the target, we can say that it is an adverse variance. Favorable means what? Favorable means any activity which will bring rise in the profit is called favorable variance. And any activity which can reduce our profit is called an adverse. Any question? Okay. Now we are going towards the variance calculation and analysis. We will do uh, calculations. A company uses standard marginal costing. Standard marginal costing. Last month standard contribution on the actual sales. What does it mean? Standard contribution on actual sales. It means budgeted or standard contribution per unit multiplied with actual sales units was $10,000 and following variances arose. Total variable cost variance $2,000, sales price is 500, sales contribution volume variance. What was the actual contribution for the last month? So you will use a formula. Actual contribution is equal to standard contribution plus or minus, plus shows favorable and minus shows adverse, plus or minus total variable cost variance, then plus or minus sales price variance. There will be no adjustment of this sales volume contribution variance, and there will be no any other adjustment even if provided in the question. So standard contribution is 10,000 plus variable cost variance 2,000 adverse. So it is not plus, it is less minus Then sales price is favorable with 500. This time you will add because it is favorable. So what is the profit? We can calculate what is the profit. 8500 is the actual contribution. Any question? Okay. Then a company uses standard marginal costing last month when the sales were at the standard selling price. A standard contribution from the actual sales was $50,000 and the following variances arose. Okay, almost the same question we have. Total variable cost variance 3500 adverse, total fixed cost variance 1000 favorable. There will be no use of this, no use of this. So we have only variable cost data 50,000. Variable cost variance is adverse with 3500. So our answer is 46,500. So A is the right answer. Then we have next question. The following information relates to the labor cost for the past month. We are required to calculate what is the labor rate and efficiency variances. First of all, I would like to rewrite the formula. Labor rate variance is equal to, formulas could be different than the study text or maybe possible your recorded lectures, but ultimately answer will be same. Purpose of the formula is same. Labor rate variance is equal to budgeted rate per hour minus actual rate per hour into actual hours paid. This is labor rate variance. And second one is labor efficiency variance. Labor efficiency variance. Total standard hours minus total actual hours into standard rate per hour. Now total standard hours are not provided in the question. So it means you will calculate the total standard hours. It is also called total flexed hours. Total standard hours is equal to budgeted hours per unit, or we can use the word standard hours per unit into actual production units. So now we will see the data for both the variances. This is budget and this one is actual. In the budgeted rate per hour is provided 10. So we have 10 minus actual rate per hour is not provided, total is provided. So you will divide total 176,000 by 14,000 to calculate your actual labor rate per hour. So we can say that 176,000 by 14,000, 12.57142. This is the actual rate, 5712. Use 5 decimal places whenever you are calculating variances or you are making any calculation which is needed for to add, multiply or divide or subtract into actual hours paid 14,000. So you can solve this. 10 is the standard cost. Standard cost is less than the actual cost. It means you are paying more cost than the targeted. That's why you have adverse variance of 36,000. So it means we have two options where we have 36,000 adverse. So we can say that A and B is completely incorrect. Now which one is correct we can determine after the calculation of labor efficiency variance. Total standard hours, budgeted or standard hours per unit. Budgeted or standard hours per unit are these 3 hours into actual production units 5,500. So we have 16,500 as total hours or standard hours, minus what? Minus total actual hours, which are 14,000, into standard rate per hour, which is 10. So you can solve this. Minus 14,000 into 10, it is $25,000 favorable. You were allowed to complete your job within 16,500 hours, but you completed your job within 14,000 hours. That's why you have a favorable variance of $25,000, and your correct answer is D. A, B, and C, all three are incorrect. Any question? Okay. Now we will move on to the next question. This one is slightly technical. The following details relate to product T, which has a selling price of $44. Direct material, direct labor, variable overheads per unit, and fixed overheads per unit. Fixed overheads per unit means overhead absorption rate per unit. During the April, the actual production of tea was 800, which was 10% fewer than the budgeted. So it means budget was 100 greater. Budgeted production units is equal to 800 units plus 100 is equal to 900. The budget shows an annual production target of 10,800 with fixed cost occurring at a constant throughout the year. Actual overhead expenditure of 8,500 for the April 20x6. Now you can see that it says actual overhead. It is not saying actual variable overheads or actual fixed overhead. It means it is a combination of variable and fixed both. Overheads are absorbed on the basis of units produced. What were the overhead variance for April 20x6? Expenditure variance. Now he says that expenditure. He is not saying fixed overheads expenditure. He is not saying variable overhead expenditure. He is simply saying expenditure. Expenditure means total expenditure, which is combination of fixed and variable both. So we will do what? In this situation, we will calculate total standard variable overheads. Variable cost is the cost which varies with the activity level. That's why $6 budgeted variable overheads per unit are multiplied with actual production unit of 800. So we have 4,800. On the other hand, total budgeted fixed overheads is equal to $4 into budgeted production units of 900. It is 3,600. So we have sum of total standard and budgeted, total standard and budgeted for the month of April 8,400 minus actual overheads 8,500. So there is a variance of $100 minus, which means variance of $100 adverse. So there are two options which says expenditure variance is adverse by $100. So we are now sure that A and B are completely incorrect. Now we need to find the correct one. Next is volume variance. Volume variance means fixed overheads volume variance. So the formula of fixed overheads volume variance is budgeted production units, which means 900 minus actual production units, which means 800 into overhead absorption rate, which means 4. So we have an answer of 400. Remember one thing, your fixed overhead volume variance is adverse in this situation because your actual production units are less than the budgeted production units. You planned that you will produce 900 units and you will bear the fixed cost for 900 units. But you are producing 800 units. So it means you are wasting the fixed cost for 100 units. That's why it is an adverse variance with the D. Any question? Next question is, the company operates a standard marginal costing system. Last month, its fixed overhead expenditure were 10% above budget, resulting in a fixed overhead expenditure variance of 36,000. What was the actual expenditure on fixed overheads last month? Budgeted fixed production overheads are treated as 100%. Are treated as 100%. He is saying that there is a variance of 10%. Actual overheads are 10% greater. So variance is what? Variance is 10% higher. It means actual fixed production overheads are 110%. And we are required to calculate what actual expenditure. That's why we will say that a variance is $36,000, which is 10% greater than the budget, which means $36,000 adverse. Now we need 110% actual overheads divided by what? Divided by this 10%, which is the percentage of the variance, and we can calculate the amount of actual fixed overhead, which is $396,000. It is possible that in an exam, a student will be unable to understand this difference, and he assumes that, or she assumes that, variance is 10%, and rather than considering actual overheads at 110%, if he or she considers budgeted overheads as 100%, then $36,000 into 100 by 10. I think in this case, he or she will get the answer of 360,000. And as a candidate, as a student, if you are unable to understand the question clearly, but you find a figure, and this figure is available here in the options, maybe you will be very happy that I calculated the correct answer, but this one is incorrect. Maybe someone is completely unaware how to solve, and maybe not able to determine or calculate any figure, suppose like 360,000, but still confused, and trying a trial and error in the exam by calculating 360,000, then deducting the variance of 36,000. There is a figure of 324,000. He or she will be very much delighted that I found a figure, because he or she knows that there's some adjustment is also needed, but this figure is also incorrect. And it is always possible that someone assumes that no, variance is 10% means what? Variance is 10% means uh, our calculation is not correct, or our calculation is incorrect. So he will or she will try to make some adjustments rather than making some trial and error. Remember one thing, if fixed overheads or any overhead is 10% greater than the budget, it means variance is 10% adverse, which means your actual cost is 10% higher than the budget, and it is 110%. Any question? Okay. Now we will move on to the next question. What was the fixed overheads volume variance? First of all, write down the formula. Volume variance deals with what? Deals with production units. So you will calculate the difference between budgeted production units, which is 20,000, minus actual production units, which is 21,000. And it is multiplied by overhead absorption rate. To calculate overhead absorption rate, we have already learned this formula under absorption and marginal costing. Budgeted fixed overheads divided by budgeted production units. 120,000 divided by 20,000. So $6 is what? $6 is OAR per unit. This is $6 per unit. Budgeted production units are 20,000. Actual production units are 21,000. This time answer is favorable with $6,000. It means you paid the fixed cost for $20,000, 20,000 units, but you produced more units or you produced greater amount of units in comparison with budget. So if actual production units are greater than the budgeted, this is called what? This is called $6,000 favorable. Next one is 351. A company budgeted to make 30,000 units of product P. Each unit was expected to take 4 hours to make and budgeted fixed overhead expenditure was 840,000. So we have a budget of 30,000 units and each unit will take 4 hours. So budgeted production hours is equal to 30,000 units into 4. It is 120,000 hours. Budgeted fixed production overheads was 840,000. So now you can calculate overhead absorption rate per hour. $840,000 divided by 120,000 hours. So what will be the answer? $840,000 divided by 120,000 hours. It is $7 per hour. Actual production of product P in the period was 32,000, which took 123,000 hours to make. Actual fixed overhead expenditure was 885,600. What was the fixed overhead capacity variance for the period? Capacity variance deals with budgeted and actual hours. Budgeted hours are 120,000. Actual hours are 123,000. It means we paid fixed overheads for 120,000, but we actually took 123,000 hours to complete the job, or we can say that the job which requires 123,000 hours, we completed successfully in lesser amount of hours with $120,000. Sorry, 120,000 hours into $7 per hour, where you have completed your job before the allowed time. Allowed time was 123,000 hours, but you completed within 120,000. So it means you saved the time. When you save the time, so you save the cost. That's why it is $21,000 favorable. There is also an answer of 21,000 adverse, and most of the students who does not know that in the fixed overheads capacity variance and in the fixed overheads volume variance, actual activity higher means favorable. He or she can pick B as the correct answer because answer will be negative, and most of the students says that when answer is negative, it means adverse. Do not memorize variances formula with the negative or with the positive. I stated in the at the start of the class that if something is increasing our profitability, it is called favorable. If something is reducing my profitability, it is called adverse. Here, I should complete my job within 123,000 hours, but I am completing within the allowed hours or budgeted hours. It means I am saving my cost with the $21,000. That's why it is favorable. Any question? QRL uses a standard costing system. The following details have been extracted from its from its budget for April 20X7. Fixed production overheads cost $48,000. Production units 4,800. In April 2006, the fixed production overhead cost was under-absorbed by $8,000 and the fixed overhead expenditure was 2,000 adverse. What is the actual number of units produced? Okay. So here he has provided us the data of under or over absorbed. So it means we will use the information or we will use the formula of under or over absorbed. According to the formula of under or over absorbed, we are provided with the information of under absorbed. Under absorbed means negative and we have $8,000 negative. Then variance is $2,000. Adverse means our actual overheads are greater by $2,000 in comparison with budget. So actual production overheads is equal to $48,000 plus 2,000 adverse. 48,000 is the budget and actual is 50,000. So here we have in the formula of under or over absorbed, actual overheads 50,000. Now the missing value is absorbed overheads. If you are under absorbed by 8,000 and that your actual overheads are 50,000, under absorbed means absorbed overheads are less than the actual overheads. With how much? You will calculate the difference between two values and absorbed overheads are 42,000. Now, what is the formula of absorbed overheads? Absorbed overhead is equal to OAR into actual production units. OAR we can calculate in the question. Budgeted production overheads are 48,000 divided by budgeted production units of 4,800. So OAR is 10. We have OAR 10 into actual production units. Actual production units are is the requirement of the question. You can solve 42,000 divided by our absorption rate, which is $10. So we have actual production units of 4,200 units. So in this question, we use two formulas. First, we use our fixed overheads variance, where we added variance amount in the budgeted fixed overheads to calculate actual overhead. Then we use the formula of under and over absorbed to calculate actual production units. Any question? Okay. And the next question is says that a company has higher than expected staff turnover. It means more people are leaving the company. As a result of staff are less experienced, than the expected. As an indirect result of this, are the labor rate variance and material usage variance likely to be adverse or favorable? When your staff turnover is high, it means you are changing your staff members rapidly. When you are changing your staff members rapidly or quickly, it means they will affect the productivity in terms of material and as well as in terms of labor. So, but less experienced people will be cheaper. So company will be able to hire less experienced people at a low cost and it will give favorable labor rate. But on the other hand, due to inexperience, they will waste the material and there will be more material usage in comparison with budgeted. So the answer is this, where we have favorable labor rate variance and we have adverse material usage variance. Right, everyone? Then we have a company is obliged to buy substandard material at lower than the standard price because nothing else is available. As an indirect result of this purchase, are the material usage variance and labor efficiency variance likely to be adverse or favorable? Substandard material means we are using the low quality material. Low quality material will lead to where? Low quality material will lead to wastages. But low quality material will be available at lower price. Wastages means adverse material usage. When you are going to buy a low quality material, it will definitely affect the productivity of the labor, and it is also possible that labor will consume more hours than the targeted or budgeted. So we have adverse material usage, and as well as we have adverse labor efficiency variance. Right? Any question? Then next question is the interesting one. F direct labor costs that are relating to last month were as follows. To standard labor cost for the actual hours worked. It means actual hours are multiplied with standard labor rate per hour. Standard hours worked 30,000. Standard hours work means budgeted hours. In fact, not budgeted. Standard hours means standard hours per unit into actual production units. This is called standard hours. Standard rate per hour is $4. Standard rate per hour $4 is multiplied with actual hours worked. So by dividing $4, I can calculate what were the actual hours. Actual hours are 29,000 and standard hours are 30,000. Labor rate variance is 5,800 favorable. Labor efficiency is $4,000 favorable. What is the actual rate of pay per hour? Now actual rate pay of per hour is the part of labor rate variance. We have a left side which is provided with 5,800 favorable is equal to standard rate per hour 4 minus actual rate per hour is the question mark into actual hours paid is 29,000. So if 29,000 is multiplying here, you can divide it with 5,800 favorable divided by 29,000. So 5,800 favorable divided by 29,000 is equal to $0.2 favorable. $0.2 favorable means actual rate is less than standard rate, or actual rate is lower by $0.2 in comparison with the standard or budgeted rate. So actual rate is 4 minus 0.2, 3.8 is the actual rate per hour. If it was adverse, then you will add, but here we have favorable, that's why we deducted. Any question? Okay. M has the following results: 10,000 hours, 10,080 hours actual work and paid costing 8770. So we will calculate what is the actual rate per hour. 8770 divided by 10,080. We have actual rate per hour of 0.87. If the rate variance is 706 adverse, labor efficiency is 256 favorable, 5,000 units were produced. What is the standard production time per unit? Now we are required to calculate standard production time per unit. Standard production time per unit is basically the answer of labor efficiency variance. So labor efficiency is 256 favorable is equal to total standard hours are needed, because total standard hours says that standard time or standard hours per unit which we are expected to calculate in this MCQ multiplied with actual production units. We have 5,000 actual production units, but we don't know what is the standard time per unit, minus actual hours per unit 10,080 into standard rate per hour. Again, standard rate per hour is not provided. So we will calculate standard rate per hour from this rate variance first. Rate variance is 706 adverse is equal to standard rate per hour is x minus actual rate per hour is 0.87 into actual hours worked is 10,080. So you will divide 706 by 10,080. You have an adverse of 0.07 per hour. 0.07 adverse means your budgeted rate per hour was lower by 0.07 in comparison with actual rate. So you will deduct 0.07 from here and your standard rate per hour is 0.80. Standard rate per hour is 0.80. Now we can use this rate here 0.80, which we determined with the help of labor rate formula. Now 0.0 is multiplying here, we can divide by 256 favorable. 256 favorable divided by 0.8 means what? 320 hours favorable. It means we are actually consuming 320 less hours as compared to standard or budgeted. We are actually consuming 10,080 hours, which are favorable by 320. Total standard or total allowed time to the workforce was 10,080 plus 320. We have 10,400 total standard hours. Total standard hours are 10,400 is equal to standard hours per unit into 5,000. Now you can calculate standard time per unit by dividing 5,000 with 10,400. So standard time per unit is 2.08. This is the right answer. So these are the reverse MCQs, and remember this thing, reverse MCQs can be asked by the examiner in the question, so attempt these questions carefully. It was the reverse MCQ, this was over or under absorbed, and then we have these two reverse MCQs. Then we have any question related to this question, this MCQ? An extract from the standard cost card for CJ is as follows. Direct labor 0.5 hours means standard or budgeted time per unit. $12 means standard or budgeted rate per hour. 710 of the CJ were produced in the period and staff worked 378 hours at a total cost of 4725, of which 20 were lost due to material wastage. So it means actual hours worked are 358. What is the labor efficiency variance? Labor efficiency variance deals with the worked hours, not with the paid hours. 378 hours are the paid hours which are relevant in labor rate variance. So the formula of the labor efficiency says total standard hours is equal to standard or budgeted hours per unit into actual production units, 0.5 into 358, 164 minus, multiplied with 710 units, actual production units, 358 are the hours, 0.5 into 710. So we have total standard hours of 355 minus actual hours worked are 358 into standard rate is 12. Actual hours are greater than the standard hours, that's why it is adverse with $36. C is the right answer. We should consume 355 hours, but we consume 358 hours, so we have an adverse variance. Any question? Okay. A company makes a single product. The following details are from the cost card for the product: direct labor, variable overheads, actual results for the last period, actual production units 500, actual labor hours 4800, variable overheads are 7700. You can calculate your actual variable overheads per hour by dividing 4800 from by 7700. It is 1.60416. What are the variable overhead expenditure and efficiency variance? Expenditure variance means budgeted fixed overheads per hour, which is 1.5, minus actual fixed overheads, variable overheads are 1.60416, into actual hours paid. So you can calculate your actual variable overheads are greater than the budgeted. That's why it is adverse with $500. That's why it is adverse with $500. Next one is labor efficiency. First of all, we will calculate total standard hour in the labor efficiency. Standard hours per unit are 10 into actual production units, so 5000. Standard hours are 5000 minus actual hours are 4800 into standard rate per hour 1.5. So your answer is 200 into 1.5, 300. You should consume 5000 hours to complete the job, but you took 4800. It means you took less time. That's why it is favorable with $300. So we have the option C as an answer. Any question? A company uses standard absorption costing. The following data relates to last month. Budgeted sales units are 10,000, actual sales units are 900. Selling price standard is 50 and actual is 52. Total production units to standard or budgeted is 39. So we have a profit of 11 and actual is 40. What was the adverse sales volume profit for the last month? Sales volume profit variance says that budgeted sales units minus actual sales units into budgeted profit per unit 11. So there is an answer of 1100 adverse. This is sales volume profit variance. Any question? Okay. A company operates a standard marginal costing system. Last month, actual fixed overhead expenditure was 2% below, and the fixed overhead expenditure was 1250. This time, variance is 1250. This time below means it is representing 98%. Our budgeted fixed, sorry, it is the variance. It is representing just 2%, not the 98. Our budgeted fixed overheads are representing 100%. Our actual fixed overheads are 98% because there is a variance of 2%. Actual fixed overhead expenditure for the last month is equal to 1250 into, we need actual 1252 is 2%. So we need what? We need 98% out of what? Out of 2%. So into 98 divided by 2. For percentage, you can say 0.98 and 0.02. So the answer is 61,250. This is our actual fixed overhead. Any question? Under the absorption costing, sales volume variance is calculated by multiplying the difference in sales volume by which of the following? When we talk about more absorption costing always use standard profit per unit. When we talk about marginal costing, it always uses standard contribution per unit. Then in the next question, a business uses marginal costing to calculate variances. If they were to use absorption costing, the current method of calculating the sales volume variance would be uses marginal costing. If they were to use absorption costing, marginal costing use contribution per unit, and absorption costing always uses profit per unit. Remember, contribution per unit is always greater than profit per unit, because from contribution you are still needed to minus or subtract your fixed overhead. That's why if we were to use absorption costing, the current method of calculating the sales volume variance would be, current method is what? Current method is marginal costing. It would be higher or same only if there is no fixed cost. If there is no fixed cost, then contribution and profit per unit will be same, but usually we have a fixed cost. That's why contribution per unit is always greater than what? Contribution per unit is always greater than profit per unit. The standard direct material cost for a product is $50 per unit. 12.5 kg is standard usage per kg. $4 per kg is standard price per kg. Last month, the actual amount paid for 45,600 kg of material purchased and used 173,280. So you will divide 173,280 by 45,600. And you can calculate your actual price per kg. It is 3.8 per kg. Last month, the actual amount paid, okay, we have already calculated, and the actual material usage variance was 15,200 watts. What was the material price variance for the last month? Material price variance is equal to budgeted or standard price per kg minus actual price per kg into actual kgs purchased. So you can calculate variance. It is 9120. Actual cost is less than the budgeted cost. That's why it is favorable with 9120. Now, what was the actual production units for the last month? Actual production units could be found with the help of two variances, like either to use the formula of total variance. Total variance says that budgeted production units minus actual production units, or we can use the formula of material usage variance. Material usage says what? Usage says 15,200 adverse is equal to total standard usage is the X minus actual usage and actual purchases are same into standard price 4. So now you can divide 15,200 adverse by 4 15,200 divided by 4, it is 3,800 adverse. 3,800 adverse means our actual usage is 3,800 more than the standard usage. So we can say total standard usage is equal to 45,600 minus 3,800. 41,800 is the total standard usage. Now formula of the total standard usage says standard usage per unit is equal to, standard usage per unit multiplied with actual production units, and we are required to calculate actual production units. That's why it is x. So you can use the formula total standard usage divided by standard usage per unit. 3344 units are the actual units. So again, it is a reverse variance. First of all, we use the data of the variance. Then we calculated our usage, which is 3,800 adverse. Then we calculated total standard usage. Then this standard usage is divided by standard kgs per unit. So finally, we calculated our actual production unit 3344. Any question? A new machine is purchased which is more expensive but requires less hours to operate per unit. Less hours to operate per unit. What is the impact on the fixed overheads variance? We purchase more expensive machines. Less hours means our cost will be lower. We will incur lower amount of expenditure. It means our expenditure variance will be favorable. And we will be able to produce more units with the new machinery in comparison with budget. So that's why we can expect that both of the variances will be favorable variances, right? Now we have a break for 5 minutes. After 5 minutes, we will resume the class.